A 38% total return ETF no one is talking about? What's going on in the world? Hey guys, it's Doug the Retirement Guy. Welcome back to the channel. And we have a ETF here that really no one's talking about at this point in time. So grab your mug, fill it up with your favorite beverage, sit back, let's get ready to find out who is this 38% total return fund and will it fit in a retirement fund? So what if I told you about a fund paying nearly 20% yield, but has a 38% total return? Because you know, I don't chase just yields. I always look for the total return picture. So we have a fund right now paying about a yield about 19.7%. Now we know yields can go up and down real quickly depending on how the stock market's doing. If the fund is going, price is going up, the yield's coming down, the price is going down, the yield's going up. But that's why we look at that trailing total return right around 38%. Now this one also carries an expense ratio of 0.35, which was another promising piece, and pays out every single month. So between all these things, it's checked every one of my boxes that says this is something for us to investigate. So before we go any farther, I do have to do the disclosure. This presentation is for educational purposes only. It's not legal advice, financial advice, or tax advice. Past performances don't guarantee future results. If you need a financial help, always go to a financial expert. Hey, since you may have grabbed your mug, maybe you haven't, but Retirement Made Easy, living on dividends. We have our own mug package. We have our travel mug. We have our 11 ounce, our 15 ounce. All of this helps support the channel to keep putting on videos like this, the higher quality videos that we've been able to do because of everyone buying the mugs. Real simple. You can use a QR code. You can use the links down below, and every dollar helps support the channel. I appreciate it if you've purchased it in the past. Thank you so much. And if you're looking forward to doing it here, we'd love to have you. So what's the fund that we're talking about? Well, that's XLEI. It's a State Street Energy Select Sector SPDR Premium Income ETF. Thank God they make it short and simple with XLEI. So this gives you energy exposure, premium income, monthly income, and it's a diversified energy leader. So this is one of these unique things that it probably is not going to be a core piece in the portfolio. It's going to be in maybe possibly in your income bucket as a additional satellite to support using something totally different other than the NASDAQ or the S&P 500 or Russell, something more into the energy side. So what exactly is XLE? Well, this thing launched in July 29th of 2025. So we're about a year, a little over a year, 13 months into this. As I said, the low cost of 0.35 expense ratio. And expense ratios, those things tell you how long, what's it going to cost you to hold the fund for over a year, basically. So if you had $10,000 invested in this, it cost you $35 of your money is going to expenses. The rest of your money is going into working capital and working to make sure your money's making money for you. So a low cost, 0.35 is what you definitely is right where you want it to be. Now all the numbers we show are always include these things. So this is just a number to look at. Doesn't really mean a lot other than if you're going to hold something for a long time. So it pays out monthly. So what they did was they used the foundation XLE, which is the Energy Sector SPDR Fund that has dividends and energy exposure. Then what they do is they overlay covered calls. So actively managed rule-based option strategy, which is where it generates that additional income from the covered calls. So the current income plus long-term capital growth gives you multiple areas of growth with income. Now, what does XLE actually own? Well, it's actually the top U.S. energy companies inside of it, which is going to be the ExxonMobil, the Chevron, ConocoPhillips. There's so many, virtually everybody who's producing up front, I'll say gas, oil, so on, is into this package. The sector split as of June was 90% oil, gas, consumable fuels, and equipment and services was making up 10%. So XLE is not a diversified S&P 500 fund. It's a bet on oil, gas, and energy demand. This is why I said this is probably going to be a separate sector in your 3-bucket income portfolio. So where does the extra income come from? And this is one of the things that's been very unique is one, the underlying dividends. So the dividends that they're getting from Exxon, Chevron, Conoco is going into the fund as they pay their quarterly dividends. Then they have call option premiums. And then they have the active management rule-based, which is very critical, rule-based, actively managed. So the decisions use what we call delta, volatility, market price signals, and set, it's not a set and forget program. They set these things to what the market conditions are telling them, how it fits their rules, and they set them out accordingly. So let's talk about that yield. Okay. This is one thing that a lot of people don't realize, but the 30-day SEC yield tells you a lot about a fund. So what it says is 2.33% of their yield is technically coming from dividends, interest, everything outside of the covered call arena. So when the fund pays 19.7%, that means the covered call is making up 17%, while the SEC, the dividends and all that, is picking up 2.33. So XLE isn't earning a 20% dividend. It's generating high monthly payouts with a mixture of investments, income options, and return of capital accounting. So it's a unique thing that they have that they're using, kind of like taking a portfolio that's getting good growth and good quarterly dividends and putting on top of it a whole covered call to generate even more income. So it does out payout monthly. Now remember, they're never fixed because look at the numbers I put on here. And this was one concern I had for retirements, which is what made me make the decision that I think this is really more of a covered, this is a satellite versus a core holding in any way, shape, or form. So March, you had 45 cents. April, you went to almost 55 cents. Then you drop down to 31 cents, then back up to 44, 53, back down to 38. So you can see where when they get the distributions coming in on the quarterly basis, it boosts their distributions. And the rest of the time when we're dealing with just the covered calls, makes the adjustment. So you're really looking at a 31 cent to 55 cent spread between it. So about 75% swing from the lowest to the highest in just over half a year. So a lot of adjustments in there. So it starts to make things a little more difficult to budget, except if you budget on the lowest end and the rest becomes bonus, it's real easy to work as a satellite again. Now, did the NAV survive the paycheck? This is the big question that comes into it. If you take a look at the total 1-year total return of XLE, it came in at 40.75%, but it doesn't have the yield. Now, XLEI has the income and was able to capture almost 32%. So there's about an 8%, really, as they say, 7.9% points difference between these two planes. So I believe what you have in an ETF that can actually create income with a very little cost of additional growth on the other side. So the big thing here is XLE has no ceiling for its upside, so it's getting all its natural. But most of the rally plus a bigger paycheck is what you got from XLEI. So I believe that is definitely a nice package compared to the underlying asset. So where does the 38% number really come from? Well, the 38% that we get from stock analysis is the trailing 12-month return, including distributions, measured through about mid-August of 2026, which is where we're at today in filming. So the official one coming from State Street came in, the year-to-date total was 24.14 with a one-year NAV of 32.84. So where are we getting these different numbers coming from? Since inception, the fund has been up to 30.68%. So that little extra is what we've received in the month of August. So just in case no one has to get yelling at me or coming back at me, we're dropping off a couple bad months, picking up a couple good months to give you the difference between the two. So now let's talk about taxes on this. Now, I'm going to give you a comparison, and I've talked about this on a few other videos before. But right now, the 2026 year to date is a heavy ROC, which is return of capital. Okay, they're posting this thing at an 89% return of capital with 11% based off of income, dividends, distributions, and so on. But here's what I always tell you got to look at. This doesn't mean nothing until you get your 1099 DIV form. When I went back and checked the tax year of 2025, a near even split came out. They made the adjustments to where 53% of the return of capital, 47% was income dividends. So right off the bat, I'm going to say, hey guys, this looks great at 89% ROC. But I think you're going to find as they get to the end of the year, they're going to make some bigger adjustments. And I'd actually go more with what's happening in 2025. So this one here is if you have it in a 401k or a Roth IRA, okay, you don't need to worry about this part of it as, I'll say as much. But if you're putting stuff in the brokerage fund and you're taking the money out, this is critical because you're losing about 40 percentage points of your ROC. That means if you're going for Medicare or if you're going into healthcare side of it, that means you have a bigger income. You got to really watch this one. So this is a little warning sign across the board. But still 53 is nice, but I'd rather see that 89 to be honest with you. So the question I get all the time is return of capital bad? It depends on what you're trying to do. If a fund has ROC, it's really the wrong question. What you want to ask is what's happening to my NAV while I receive it. Okay, so when you look at things, and I know I do a lot of this, but with weeklies, you'll see ROC heavily in weeklies, and you'll see the NAVs dropping off dramatically, and that's where you see a lot of people talking about NAV erosion. Well, that's a dangerous side of ROC. They're going to use it to their advantage to continue to keep their dividends up and paying you so that you're happy about getting your dividends. But you're taking literally, you are getting your own capital back because it's hurting and affecting the NAV. So if you got a fund like this, that the NAV is growing, your income is growing, then the ROC is a positive thing because that's going to help you in your tax purposes and accordingly. So 1 year returns before and after taxes, just to give you an idea what happens with this. So your NAV return gross was 32.84%. That's before taxes. Now, if we use that 2025 package after taxes on distribution, you're going to be down to about 25%. So it really comes into play is where that magic number comes into effect. So you got after taxes on distributions, and then you have after taxes on distributions and on the sale. So if you were to take it and sell it all in the same year, you're still up 19.24% after paying your taxes onto it. Now this is a number that it's going to be different for everybody. So I just wanted to play with this a little bit, kind of throwing something new at you out there. If you've watched a lot of our videos, kind of throwing something new, how taxes can affect your total return numbers across the board. So how would I use XLE for retirement incomes? Well, the answer is, I definitely would do this I call it with a caveat. As a satellite position inside a diversified retirement income bucket, never as the whole portfolio. Okay, I think you guys would all know that. I'm not one of one and done. I'd use this in the multiple spread. I have my NASDAQ, I have my S&P 500s, I have my Russell. Okay. And then after that, I always said you want to do some international. You may put in something into energy. You may put something into the real estate market, the REITs. You may put something else. Things that you don't need to live off of, or you don't need to, I call it, rely on 90% of the time. But these are boosters to your income side of it. So like $750,000 into XLEI alone, your paycheck now depends on Exxon, Chevron, OPEC, oil prices, geopolitical. I can tell you right now, the Straits and Hormuz, you're dealing with all that. Why I always say that, you want a broader exposure between the S&P 500, NASDAQ, small caps, international, bonds, cash. It's just another piece of the puzzle, putting it into it for energy. So do you put this into your portfolio? I think most definitely, but it's always a satellite piece to it. Let me know your thoughts. Do you think that this should be in a retirement fund? And maybe you own it. How has it done well for you? How is it done? Let me know in the comments below. I'd love to find out if you've actually owned it, who has it, and how things have gone. So where does XLE really actually fit? Well, it doesn't belong in a foundation fund. I think you guys would know that one right off the bat. Growth, it's not ideal for. You could, but I like that VOO, QQQ, QQQM, VUG, and the growth funds. This thing would fall into my income bucket. I'd put it as a satellite in my energy folder and just let it sit and go from there and pay attention to it. That's how I would use it. So, two risks to share, and being straightforward and honest with you. Energy can turn fast. Oil could fall, demand could weaken, global recession could shrink the consumption, margins compressed. If XLE drops 25%, receiving option premiums doesn't shield the principal across the board, you're dealing with something. That's why I keep telling you, saying it's satellite. It's a smaller portion, because energy is such a fast turning piece and puzzle. But the trade-off is this: the calls can cap your upside. So we saw that when I showed you the screen of the 40.75 to the 32.84. There is some capping of that growth, but you're generating income off of the top of it. So I'm not going to say these, you always have risks with every investment you make. But this is very, I won't say minor. These are just pieces of the puzzle that you have to understand and know. Energy can turn fast, and caps upside will always cause less of a return. So don't chase that 19.7%. Okay. Remember, buy the total strategy, not just the headline. Don't buy just because I said, hey, a 38% total return. Oh, that's what Doug says, always total return. You need to do your research. You need to find out what is the energy sector exposed right now? Does the energy earn a spot in your diversification? Do you need energy in your pot? Do you want to put this as part of a convenient monthly cash flow? Okay. Am I willing to give up the upside to get this income? Every portfolio is different. Every person's different. Everything works accordingly. And you got to ask these hard questions of your own. And that is, the 1, 2, 3, 4 questions. How does it fit for you and for you only? Not just because you see a video that says 19.7%, which we love to have, but you got to make sure it fits and it's the right piece for your portfolio. Again, I know I repeat myself a lot with this, but it's nice to get that 19%. It's nice to get that big total return. But I also buy it in a smaller package and a smaller portion as a satellite booster to help grow my income. So overall, my report card on this, income, giving that baby a straight A. Growth, give me a B+. It's impressive so far, but covered calls can always, it's trailing the underlying XLE, which I expect it to, but it's right there. Total return, man, I'm positive A's on this one. Expense ratio, very low, give it an A. Tax efficiency, boy, I tell you what, I struggled with this one. I ended up at an A-, but looking at 2025, I'd say it's probably more like a B or a C. Looking at what they're doing in 2026, if they continue and hold it, they'll get that A. But overall, I got to put a warning sign out there in case you're running into some tax issues. Now, the other big one, C, is not diversified. You are dialing into the oil business, and that's what they're, grapping on now. But is this a retirement fit? I gotta be all front with you guys. This is definitely one of those for the satellite position in a retirement for monthly income. So I'm very excited and proud of it. So again, if you own it, leave a comment down below. How do you like it? What do you do with it? Um, and does this fit your portfolio? I love to hear from my viewers at all time. I read all of those. I may not respond to them all, but I definitely read all of the reviews across the board in the comments. Thanks for watching, and we'll catch you next time.